We've been watching President Trump speak at the World Economic Forum in Davos, Switzerland. Just there, he was being questioned by Borge Brende, who is the CEO of that organization. This follows a lengthy speech that the president gave. Of course, the heart of that was his pitch on Greenland, that he thinks the United States should own the island instead of just, as he put it, leasing it, because he said that would make it easier for the U.S. to defend it. He pitched it as a matter of national security importance, and he said that he wanted to enter immediate discussions, negotiations to buy the territory. He did say that the U.S. would not be using force, but there was a bit of an implicit threat, because he said if Europeans don't agree to this, that the U.S. and he would remember whatever that would imply. So all of this said, we are seeing markets recover to some extent from the selling that we saw yesterday when we saw the rhetoric on Greenland increase. We've also, of course, been watching the bond market closely because we saw bond yields go higher yesterday as well. We are seeing a little bit of a come down on that front, but not a very dramatic move in the fixed income market. So that's just some of what he said in the speech, but I want to get to some reaction here, because joining me now we have Henrietta Treyz, Veda Partners Managing Partner and Director of Economic Policy, Terry Haines, Pangaea Policy founder, as well as Michael Goosay, Principal Asset Management Chief Investment Officer of Global Fixed Income. Henrietta, let's start with you. As I said, the markets seem to be somewhat relieved that the president's rhetoric on Greenland was not more forceful. I'm curious what you think, whether this did represent a step down.
Yeah, I think the market is right to respond to this as the taco moment. The president has the ability to put tariffs on. But one of the things I think is underappreciated is that yesterday, that authority to impose tariffs was almost stripped away by the Supreme Court. And that could happen again at the end of next month. So the president is building up new and different ways to justify tariffs against the EU, the UK, and other nations, and now is incorporating Greenland into that conversation. And really importantly, it must be made transparent that the president does not have trade deals with either the EU or the UK. We have, outlines of a plan, but there's no deal. And now planned tariff reductions are not going to happen on the EU's part. They were going to take their industrial tariffs on the US down to zero later on this week, and that's not going to happen. And the bottom line is that all these deals and negotiations that the president likes to speak to have not concluded. And now we're layering on Greenland, which is a very important topic, but also importantly a distraction from the fact that those tariff authorities are about to be stripped and that we don't have deals with either the EU or the UK.
And Terry, I think it's interesting when the president talks about how economically things have turned out better than a lot of the forecasts, right? Even with the tariffs in place. It's worth remembering the worst case tariffs are not, in fact, in place, right? That he introduced on Liberation Day. I mean, how do you think this pitch plays, not just there in the room in Davos, where it probably doesn't play great, but with the American people?
Well, on one level, it's greatest hits for an American audience, right. But it's it's not greatest hits for a European audience. And I think there's 3 points underlying that speech. First is that, as Lutnick wrote in the Financial Times yesterday, they went there to confront the status quo, not defend it. So they're certainly doing that. The second is a direct challenge that the Davos man has failed here, and we're going to do something different now. And thirdly, that part of what we're doing differently is taking national security a whole lot more seriously, and international security. Trump is quick to say, a whole lot more seriously than States administrations have done or European administrations have done. It's not for nothing he mentions the lack of European support for NATO over the past decade plus.
Yes, although he also said he didn't think NATO would come to the U.S. aid if it was called upon, and of course it did in the wake of 9/11, but he chose to not remember that particular item. Mike, I want to get to you because the bond market action yesterday in particular, as our Jared Blickery, our markets editor, pointed out, taco, or Trump always chickens out, the president has been more reactive in this term to the bond market than to the stock market. What did you think of the action yesterday? How much of it was Japan versus Greenland, and what happens now?
Yeah, thank you. I think there was a lot to parse in this speech today, but what stood out to me is he spent a lot of time talking about housing. Housing is very dependent on levels of interest rates, whether those are Fed fund rates or longer term interest rates. And so to your point, he has become more focused on bonds in this term versus the equity market, which was a lot of the conversations in his first term and even early on in this one. The bond market is concerned. The bond market's concerned for multiple reasons. I do think yesterday's price action was largely driven off of the Japan concerns, fiscal concerns, whether that's additional stimulus or inflation risks or just a mismanagement of the way that bond market operates. But the overall concerns in the bond market are real today. There's obvious additional stimulus. You heard some intonations of that today in order to stimulate growth, in order to make housing more affordable. That do worry the bond market because they are largely inflationary risks that could push long-term interest rates higher.
And I should mention, by the way, on the housing front, there's more reason for pessimism there today because we just got U.S. pending home sales, which were down 9.3%, which was the biggest drop since 2020 with those pending home sales numbers. And that's the number for December, by the way. Michael, I was struck when the president was doing the Q&A and he was asked about U.S. debt. He basically said the strategy is to try and grow our way out of it. So, in other words, he didn't say we're going to cut spending, or he didn't give the sort of priority to cutting spending. He talked about growing his way out of it. Is the bond market confident in that strategy?
It's hard to really cut spending to a large enough degree to be able to truly impact the deficit. So the right answer is to try to grow at an above trend rate, which would allow additional revenues to come into the government coffers and ultimately result in the ability, if you didn't spend it, to pay down debt and to reduce the overall deficit of the country. So it's not surprising that he would say that. The biggest issue with the bond market about the debt or deficit is, as long as somebody's willing to lend money to the U.S. government, which seems to be the case, both domestic investors as well as international investors continue to buy treasuries and corporate bonds, then it's not an issue. It's when those investors strike and get concerned about either the quality of the debt or the value of the future dollar that they're putting in the market today at current interest rates, that you'll actually see the real spike and that's what you saw in Japan, is that concern playing out with long-term interest rates spiking so quickly and so rapidly.
So Henrietta, I want to go back to you because there's also the matter of how much we would pay for Greenland, I guess, if we did end up buying it and what that would do to the whole debt picture. But I also want to come back to the issue of, yes, I know this was the international stage. The president was not explicitly speaking to the U.S. people. And as Terry said, this was sort of a greatest hits outside of the Greenland discussions. But, the president saying his approval ratings are great is not the case. The approval ratings are not great right now. And so with him focusing on Greenland or Venezuela or what have you, what do you think the kind of ripple effect is?
Yeah, roughly 1% of Americans think foreign policy should be the president's main focus. The vast majority of Americans believe that inflation, prices, the economy, and jobs are the foremost areas of concern for them, and that's what they'll be voting on. The president is 25 points underwater in his handling of the U.S. economy. That's a death knell, both for the president and down ballot for Republicans going into the midterm cycle. So when the president speaks to Greenland, it should have the effect of boosting foreign policy. It's just a general thing that's in the ether in the American public, but we are famously ambivalent about foreign policy here in the United States. It's not what voters go to the mat for. And that's the reality that the president and the Republicans are facing down ballot, and why we're forecasting about 25 seats in the House will flip to Democratic control next year.
Do you think, Terry, that the president made a convincing case to the American people that Greenland is necessary for the U.S.?
I think they make a case that a pretty good case that it's essential to U.S. national security, and that's been pretty obvious for a while. You got to separate the signal from the noise on all this stuff. The signal is what markets might be reacting to, or certainly the press is this morning, that Trump won't use force with Greenland. The signal is that the United States is not going to back down from increasing the U.S. security perimeter and get greater access to Greenland minerals. And the president's not going to be swayed by the polls of the moment on doing that or doing the economic.
Terry, I apologize for interrupting. If that's the case, if that's the real signal that the president was sending, should the market be relieved then, or should the if indeed we are going to see a more belligerent, for lack of a better word, United States, does that mean that it's sort of all clear for markets?
I don't think the markets, I think, are not reacting so much to Greenland as the idea that there might be a bigger reason why the United States has its hair on fire about national security. And that's been building for a while. The Trump people have been trying to, both shore up United States national security and not alarm markets too much about this. But there has been the highest geopolitical risk in over 50 years, and that's been going on arguably since the Ukraine aggression 4 years ago, and made worse by what's going on in the South China Sea, the Middle East, and all the rest. Markets have brushed that off. The last time they had a shudder about this, that it might not be going away, was in the middle of the summer with Iran, and it might be back to some extent. So there's that. Beyond that, Trump's not going to be dissuaded because everything's compared to something else, and Trump at this point is roughly as popular as Bush 43 or Obama were in their second terms. And he's by far more popular than either Republicans or especially Democrats, who are like 25 points underwater right now. So, the bottom line here is that they're not going to be dissuaded by polls of the moment, and the fundamental foreign policy, which includes tariffs, is not going to be dissuaded either. They're going to continue on with this, whether anybody particularly likes it or not.
Terry, Henrietta, Michael, thanks very much. And thanks for sticking around through the speech and giving us your reaction. We appreciate it. And let's now get some more reaction from on the ground in Davos. Steve Clemons is there. He's the national interest editor at large. Steve, thanks to you as well for sticking around through that speech. So as someone who is there and who is talking to people in Davos, ahead of the speech, I'm sure you were talking to a lot of folks. What do you think the sort of conversation is going to be like now that the speech has been delivered?
So, look, I want to be respectful of President Trump, but the speech, given the anxiety, was sort of a dud. People were thinking worst case scenarios. I mean, the anxiety levels in Davos have been through the roof. And of course, there's a giant delegation coming with President Trump that's been here. I mean, Scott Besant's been here since Monday. Marco Rubio just got here. You've got other people. Howard Lutnick I saw last night. You have interesting people, Memenos. He brought so many people, giant U.S. delegation. And people just thought this was going to be a big American statement on something. Leaving NATO, hyper-nationalism. He had some tough love for Europe in his speech, but really before this this speech happened, we were warned. We were warned by folks around the U.S. delegation, clear our schedules for Wednesday afternoon. President Trump is going to do something so big that it will take away our whole afternoon. And that clearly didn't happen. I mean, he basically calmed the markets, calmed the temperature on Greenland, saying he's not going to take it by force. And, he didn't really diverge from something. There was nothing big, nothing new. And this was a kinder, gentler version of Donald Trump than was expected by the street here in Davos, if you can call it that.
So what do you think the speech achieved, Steve? Was it just a matter of sort of, as we have seen, by the way, in this playbook many times before, sort of whipping up that hysteria and then stepping in and saying, well, it's not going to be that worst case scenario?
Well, look, I think the truth is every president, not just Donald Trump, every presidency is a schizophrenic exercise with dominant personalities or dominant forms, competing with subordinate forms, and they take turns. Just because we saw a calmer Donald Trump that's here and so far has been largely pleasant, even in delivering his tough love about what he sees as America's need, a national security need to have Greenland, and that we deserved it, that he wasn't going to use force. This is, I think this, the European community is breathing a sigh of relief for a moment, but they don't know whether to trust this direction because they're used to flip-flops. Nigel Farage is here, who's head of the UK Reform Party, and there was a rumor that Nigel Farage and Donald Trump were going to come together, do something big around, populists of the world unite, etc. But that hasn't happened, at least yet. And I sort of think it is interesting that Donald Trump is, by keeping his powder more dry in this case, it may be available down the road. And it kind of keeps everybody on their toes guessing. And so as you just, indicated, Julie, the markets seem to be, relieved a little bit. But I think overall, there's a kind of ongoing simmering anxiety about where America's going, whether the transatlantic relationship is solvent, whether NATO means anything anymore. All of that is still percolating here in Davos.
Is there a Danish contingent there, Steve? And have they been speaking up?
The Danish have been speaking up, and everybody around them, Finland, Norway, and frankly, all of Europe. President Macron and others have been doing this. But I have happened to see I've been with the Danes, the Finns, the Swedes, etc. It comes up everywhere, and I haven't seen them since the speech, right? So I'm in my apartment here right now in Davos, so I haven't been out on the street since then. But the I would call it the decibel level of concern in these nations has been extremely high, like off the roof. And it has come up everywhere, over and over and over again. And I think almost an expectation that Donald Trump wasn't going to back off or yield. But, President Trump continues to sort of surprise people, whether he's, moving up the tempo or dialing it down. So there, again, I think talking, to Denmark and representatives of Denmark and everything around that neighborhood in Northern Europe has been one where it was creating a lot of interesting questions about what the social contract is of security is among allies in NATO. And if this really got pushed, what would they do? That's what we've all been talking about.
Steve, I'll let you get out there on the streets and start talking to some
Julie.
folks. Thank you so much. Appreciate it.
Thank you.
Coming up, Netflix shares under pressure as the company continues to fight for Warner Brothers. Netflix's outlook for 2026 disappointed investors Tuesday as the company said it continues to fight to acquire Warner Brothers' film and TV business. Ahead of earnings, Lightshed Partners analyst Rich Greenfield told me it was key whether Netflix is approaching the deal from an offensive or defensive position.
Is Netflix doing the transaction? Meaning, are they bidding for Warner out of a position of weakness? Like, is engagement stagnating? Are they having trouble driving engagement and driving more subscriber growth and revenue without Warner? And is this sort of a defensive move, or is Netflix crushing it?
So for more on Netflix, I want to bring in Robert Fishman, MoffettNathanson senior analyst. And Robert, I'm curious how, now that we've got the numbers, that question was posed before we got the numbers. Do you think that this bid for Warner Brothers is an offensive or defensive position for Netflix?
Great. Thank you for having me. So I think what's clear from the results and where the investor debate is right now, whether or not offensive, defensive, I think it's the truth is it's probably a little bit of both. And the reality is Netflix business is a very strong business. When you think about the levels that they're at, 325 million subscribers now, which were a little bit lower than we thought, but at the same time disclosing that data point, showing how large of a base and global scale that they still have, how fast they continue to grow. So fourth quarter results were strong. And thinking about the guidance for 26, that's what investors are debating in real time now, because the top line revenue growth usually starts out a little bit more conservative. The range of 12 to 14% reported revenue growth, we were at 13% going into it, so that came in essentially in line. On the margin front, that's where some of this posturing could come in as it relates to the Warner Brothers deal, and whether or not Netflix is looking to accelerate its content spending to help show how strong of a platform they have and the ability to really invest behind it. So we would argue that the margins will likely end up even better than what they're talking to right now.
Robert, how much does Warner Brothers do for Netflix from a content slate perspective and from a revenue driving perspective?
So it has a significant potential to accelerate and add on to the core strength of the Netflix business when thinking about all of the assets that Warner Brothers comes to play. Part of the reason why we upgraded at the beginning of last year, Warner Brothers Discovery, was essentially that untapped value of all of the assets that they have, starting with the Warner Brothers catalog and library, all of the amazing IP that they have, both on the television side and theatrical. And then you have to add in HBO and all of the premium branded content there, along with the HBO Max platform. So there's a lot of great stuff that Warner Brothers brings, which is obviously why we're at the price that we are now, that Netflix just amended their offer yesterday for the all-cash deal. We are still expecting Paramount Skydance to come in with a higher bid, and we'll learn the results of the tender offer, within the next couple of days, probably.
And Robert, that 325 million paid monthly memberships that Netflix reported, how close to peak do you think that is? How much more runway do you think they have, both in the U.S. and internationally?
Right. So again, giving us the data point at 325 million subscribers, clearly a step down from the record growth and very elevated levels of growth coming out of COVID. But at the same time, they still grew over 23 million subscribers last year in 25. And we, to answer the question, think that there's a lot more runway to go. Clearly, different regions and territories have different levels of penetration. And while we don't have the breakdown of all the different regions, I think it's fair to assume that there's still a tremendous amount of potential and faster subscriber growth coming in some of the more developing regions like APAC and even Latin America.
And just to make sure I understand you correctly, when you talked about the margins and the sort of content spend, if Netflix does finally succeed in buying the film and TV business of Warner Brothers Discovery, do they sort of lean into that, or do they still make new content at the same cadence? What do you think that will look like?
So they will have access to clearly a much larger content spending budget. And we think that over the long term, there's clear opportunities that will come out of that in terms of either refocusing some of the content spending. Probably what we've been talking about for a while is the importance of sports content and other live premium content that they can add on to their platform to help drive that advertising revenue that much quicker. So that's one area of opportunity of reshifting some of the existing content spending that they already have. But thinking about the combined Warner Brothers content spend with Netflix, it's a pretty powerful content engine, both on the premium side and all of the vast quantity and breadth that Netflix content brings to the table. So we do think that there are some pretty meaningful efficiencies for that over the long term.
Robert, good to see you. Thanks a lot.
Thanks for having me.
Coming up next, we will turn our attention to earnings from Johnson & Johnson and get reaction there. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke DePalma. We're live at the NASDAQ here in Times Square. Let's turn now to some of today's top analyst calls on Wall Street, because today we're watching shares of Kraft Heinz, Abercrombie & Fitch, and Oklo. First up, Kraft Heinz. BNP Paribas cut its rating on the stock to underperform from neutral. Now, this comes after reports that Berkshire Hathaway may soon sell some or all of its stake in Kraft Heinz. It owns roughly 325 million shares, and it's currently the largest investor. Now, last year, Warren Buffett expressed disappointment after the food giant said it planned to split into two companies. This comes roughly 10 years after its $46 billion merger. Wall Street is mostly on the sidelines on the stock, with 3 buys, 17 holds, and 4 sells. Next up, let's take a look at Abercrombie & Fitch. Citi upgraded the stock to buy from neutral. The analyst thinks the recent stock sell-off was, quote, unwarranted. It believes the retailer's top 2 brands, Hollister and its namesake brand, Abercrombie & Fitch, seem well positioned for growth in fiscal year 2026, and that should drive another year of strong free cash flow. There are 8 buys, 5 holds, and no sells on the street. Lastly, let's take a look at Oklo because Bank of America upgraded the nuclear startup to a buy from neutral. This comes after its recent agreement with Meta to build a phased, roughly 1.2 gigawatt power campus. Now, the analyst told clients in a note that this marks real executive progress with prepayments signaling advanced nuclear moving from just concept to delivery here. Now, keep in mind, shares are also moving higher this morning after President Trump said, quote, I've signed an order directing any approval of many new nuclear reactors. We're going heavy into nuclear. That was at his speech at the World Economic Forum Davos Summit. Now, there are 13 buys, 5 holds, and 2 sell ratings on the street. Keep right here, though, on Yahoo Finance because we'll be tracking all the latest market moves and top calls throughout the session.
Johnson & Johnson out with fourth quarter earnings. Their sales beat expectations, led by strong growth for several new cancer treatments. J&J also issued higher than expected 2026 guidance, kind of bucking concerns about the drug pricing deal it struck with the White House. Joining us for more is Vamil Divan, Guggenheim Securities senior research analyst and managing director. He's got a buy rating on J&J and a $277 price target. So the numbers look good as far as I could tell, Vamil. So what happened, or excuse me, $227 is your price target. So what ended up, what do you think is responsible for the drop that we're seeing in the shares?
Yes, I think it might be a couple of things. I do think the numbers were good. I think the guidance was good. Maybe there's a little bit of expectations for a higher earnings guidance for 2026. Always tough to predict exactly what investors are looking for there, but maybe that's a little bit soft, but still I think fine. There also was this ruling that came out last night related to the talc litigation that's been ongoing for the company for many years now, which suggests that this process is going to continue. And a number of cases that I think Johnson & Johnson was hoping to have thrown out are not likely to be thrown out now, and this process continues. So I think that may also be a little bit of a headwind, just as people digest that news. I don't think it's a fundamental issue or concern for the company, but the stock performed very well last year. One of the best performers in the group. I think maybe it's just giving a little bit of that back as people may be a little disappointed on that headline. And again, on the guidance not being as high as people maybe hoped.
And the company said that the sort of deal that they made with the administration over drug pricing, it sounded like what cost them in the pennies, I guess, for earnings per share. Or how are you estimating that out? And what effect could we see going forward for that?
Yeah, so I think similar to other companies that have done these deals, they're all saying it's sort of a modest impact, nothing too dramatic, but it is having a little bit of an impact on the top line and the bottom line as they're giving up a little bit on price to the U.S. As part of those agreements. So I don't think it fundamentally is changing the outlook for any of our companies, honestly. I think we also wonder, are these all firmly in place? We think they are, but as we see with this administration, things can go back and forth a little bit. So, but I think if they stay the way they are, I think it's manageable. And really fundamentally why we upgraded the stock last year is the underlying new product story that they have here. A lot of exciting products. You mentioned some in oncology that perform well this quarter. Also in immunology, they have a number of attractive assets. So I think it's that new sort of product story, this accelerating growth we're seeing that gets us very excited, even if that agreement maybe trims a little bit off the top line and the bottom line.
And as you mentioned, I mean, the cancer franchise seems to have performed well in the quarter. They have 6 cancer drugs that saw pretty decent-sized increases. I mean, as you know, the challenge for many of these legacy pharmaceutical makers is they've got patent protection rolling off. They have to come up with a new pipeline. How would you situate, or what grade would you give Johnson & Johnson versus some of its competitors in terms of that transition?
Yeah, so a lot of that is just timing. So they went through a very tough period over the last couple of years where they lost patent protection for a key immunology product called Stelara, which was a $10 billion product. And they're in the middle of losing patent protection for a couple other smaller products this year and next year. But they are really the start of this new cycle of products that I was mentioning that just had great data over the last couple of years. One that launched last year, they got approval for a new formulation of a lung cancer product at the very end of last year. We're expecting an approval in immunology in the coming months. So that's what I think gets us very excited. They're on the right side of this cycle and at the beginning stages of a new product cycle coming through this year. So that's why I think they've navigated the IP issues that they had. That's why we were neutral on the stock until the middle of last year. But as they showed that they could navigate that, delivered good new data for exciting new products and are now launching those. I think they got several exciting years ahead of them, really almost to the end of the decade. See a nice period of growth for them.
So, Vamil, given that we've seen a little bit of a pullback today on some of the things that you described, and you've got that buy rate and that $227 price target, what milestones do they need to hit this year to keep the momentum going from last year?
Yeah, so I think it's really going to be a lot about commercial execution this year after a lot of good data over the last couple of years. So I mentioned there's a new product in immunology for psoriasis that we think might get approved by March. In April, there is a bladder cancer product they got approval for last year, but the reimbursement part of that should get sorted out by April. So I think the uptake of those two products, one is called Icotai, the other one Inlexo, what we see from those products in the second quarter, third quarter, fourth quarter, I think will be very important, along with obviously continued progress with Darzalex and Tremfya and some of their core products that are already doing quite well. So if they can show that they can launch these new products well, I think more people come around to the fact that this is a new era for this company and a new product story that's just starting.
Vamil, thank you so much. Appreciate it.
Yeah, thank you.
Coming up, the outlook for ETFs amid renewed trade fears. That is next on Market Catalysts. Stocks attempting to recover from Tuesday's sell-off, markets shifted into the green after commentary from President Trump at Davos, where he confirmed he has no plans to take Greenland by military force.
People thought I would use force. I don't have to use force. I don't want to use force. I won't use force. All the United States is asking for is a place called Greenland.
For more on how investors should be positioning with that renewed uncertainty, let's bring in Scott Dennis, TCW Managing Director and Head of ETFs, for this week's ETF report brought to you by Invesco QQQ. Scott, thanks for being here.
Thanks for having me.
So, obviously stocks are higher now after the president's comments. They were low yesterday, but we've definitely seen over the past year sort of geopolitical statements, the president talking. We've seen since the beginning of this year also. Markets react, and then we kind of see things kind of bounce around. How should people be thinking about that from an ETF perspective?
Yeah, I think, well, first of all, from an industry perspective, 2025 was a tremendous year. ETFs in general grew by 33%, up to $3.5 trillion. To get to your point, what's interesting to me about last year was the growth of active ETFs. And I think that's very much is happening because the market is so volatile. There's a lot of volatility, a lot of uncertainty, so investors are seeking and looking for ways to invest in an active way. And they seem to be doing that. Well, I know they're doing that in the active ETFs. And for example, active ETFs last year grew by 63% in assets versus passive. So there's clearly, at least our opinion at TCW, sort of this secular shift that we're seeing and a move from sort of passive ETF implementation to an active ETF implementation. And ETFs in general give you intraday liquidity, so the ability to transact when markets move, when there's a headline or when there's other volatility in the marketplace.
And was some of that money, or I guess it was a high proportion of that money, going into ETFs that sought to dampen that volatility if it was occurring, or what were we seeing on that front?
I think there definitely was that. I mean, years ago, when we've seen a lot of interest in minimum volatility type of ETFs. At TCW, we are much more active, meaning that we are taking our high conviction, concentrated portfolios where we're taking a look at fundamentals and relative value to implement strategies where we're generating alpha. So we're moving quickly. We're taking a look at what the market is giving to us and then reacting in scenarios like that. Liberation Day, for example, we don't love volatility, but volatility is good for active management. So we took advantage of that in terms of buying relative value in Liberation. And yesterday, another example, we obviously had a sell-off across rates, currencies, and equities, and those present opportunities for active managers to generate more alpha.
So did you see yesterday then, just said a little more explicitly, yesterday was a buying opportunity in equities, do you think?
I think it was a buying opportunity. Again, TCW being an active fundamental driven, if there is a sell-off and that provides relative value in equities, we'll certainly do that. If our active ETF franchise is primarily thematically based. Right. So if there's opportunities in energy or opportunities in AI, we'll take advantage of that. On the fixed income side, we obviously saw a lot of some movement, some rise in JGBs overnight. I do think on the active fixed income franchise side of the house, we certainly would take advantage of potentially, particularly in the long end of the curve, a sell-off in JGBs.
The Japanese government bonds, for those who don't, not the Jerry Garcia band, which is always where my brain goes. So when you look at what's going to happen this year in terms of the growth, the continued growth in active ETFs, do you think it's going to be more on the fixed income side, more on the equity side? What do you think is going to be now the next sort of phase of what's driving that?
Yeah, I mean, last year the growth was both in fixed income and in equities. There certainly was more growth on the equity side of the active ETF space. I think going forward in 2026, I think we're going to see the same thing. I think there's still going to be this steady growth. I actually think we're going to have an acceleration of growth going forward in 2026. I'm a former bond trader, salesperson. So, on the fixed income side specifically, I think there's opportunities, particularly in active and a flexible type of environment. One of our active fixed income ETFs, FLXR, is an unconstrained fund where it can kind of rotate into different sectors. It can take advantage of relative value. It also can take a look at certain securities, certain bonds that we feel are undervalued or we have conviction that can generate alpha. For example, credit spreads are historically tight. They have been for several years. So we're in Flexor and across our ETF franchise, active ETF franchise, we're underweight credit. We're making up for that high quality by generating yield in the securitized space. So we feel that securitized, and you'll see this playing out in something like FLXR. We're able to generate high quality income in that product.
And just quickly then, I'm curious what your outlook for yields is this year in the Treasury market, especially given the past couple of days.
From a house perspective, I definitely think we're expecting to see the Fed to cut a couple of times this year. We think it's going to be relatively slow and steady, and it's really going to be dependent upon what news and what headlines are coming out there. And we saw a lot going on this morning with Trump speaking from Davos, so that could certainly have an influence in terms of our policy. Our portfolios, Flexor, for example, is positioned shorter in duration, so it's positioned both for potential Fed reduction in rates or maybe a longer pause in that. So we'll take advantage if rates do lower in a Fed cut, but at the same point, we're still able to generate some additional yield and some carry in that part of the curve.
Gotcha. Steve, thanks for coming in. Or Scott. Sorry, I'm all over the place with names today. That's what happens when I listen to a more than hour-long speech. Thanks so much. That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. More Yahoo Finance is coming up.